Joe, I read your notes this morning. You're quite cautious on how far the Fed will go. You think 3 might be too much. What will it take you to change that view?
I think ultimately with the Fed, what would change my view as far as them raising rates more than 3 times is if inflation does continue to spiral higher. I mean, we're of the camp that inflation, while it's very high right now and very uncomfortable, that we are probably a month or 2 away from it actually peaking on a year-over-year basis. So we think that the Fed will see this, and we think that what usually happens with the Fed is they talk a lot more than they actually do things. So they will actually have, and the market is aggressively reprice inflation as far as interest rates go, at least for the first 2 weeks of the year. So we think that the market is going to do a lot of what the Fed's heavy lifting needs to do. And so we don't think the Fed will actually need to move more than 3 times.
Joe, there are plenty of well-known voices out there that are saying that the Fed is still behind the curve, that while inflation, as you say, may come down, may be peaking soon, it is still going to remain elevated and be sticky for quite some time. Factors like rent are going to have a long-lasting impact on this. Bill Ackman was out over the weekend tweeting. He says that we should even consider the possibility of a 50 basis point hike coming from the Fed. If you were to see that kind of maneuver happening, if you were to see the Fed being that aggressive, how significant would the repricing be, and how much would you have to change your current portfolio setup?
Well, I will say this, Guy, if the Fed raises rates 50 basis points in March, that will be highly disruptive for financial markets, because I think that the market is not expecting that at all. And I think that even with the Fed's messaging, they haven't communicated that. So that would definitely be somewhat of a black swan event. And I think that you would see markets go a lot lower, equity and fixed income. So, and I think that, we're not positioned for that. That's not our base case at all. And yeah. I think the Fed is very conscientious about market reaction and market volatility.
Okay, given all of that, and I hear what you're saying about maybe the Fed potentially doing less as inflation maybe undershoots expectations towards the sort of the back half of this year. Joe, how are you positioning for that? What's the setup right now?
What we like right now, Guy, is things that, companies that make things that we can touch. So we're thinking about, material stocks, energy stocks, which are, underpinned by strong global growth. We like financials. That's probably not as contrarian as it was at the beginning of the year, just because rates have moved so quickly, so fast. But when we like industrials. So we think that if you have overweight to those sectors, the investors will be pleased with their performance throughout the remainder of the year, because we're in a rising interest rate environment. There's going to be multiple compressions. So investors have to realize the things that worked last year won't work necessarily this year.
But energy's been on a great run. Financials have had a cracking start to this year. I appreciate the Friday and the reports from JP Morgan, Wells, and Citi may have kind of slightly changed the narrative a little bit, maybe more for JP Morgan. Do you think that a lot of the good news is already priced into those areas? Why do you think we can see significant upside? Some of these financials have moved 10 to 20% already this year.
Sure. And granted, the market doesn't move in a straight line. We think that, a lot of the, financials were, not really owned by institutional investors. They're under-owned a little bit. So we think what we've seen in financials, if you go from an oversold to an overbought position. So it probably makes sense that the stocks are probably going to digest some of the news now, especially with earnings season starting. But we think that once, the earnings comes, that's a clearing event, and these stocks will outperform going forward.
So where does that leave big tech?
I think that's a great question, because I think we go back to what I said earlier, that investors have to realize the things that worked last year probably won't work necessarily as well this year. So you have big tech, which are high multiple stocks, and you have a rising interest rate regime, so which usually does not historically, those don't work well together. So we think that big tech is probably is best as a use of a source of funds.
Joe, what's your degree of certainty around this year? Last year just felt like a straight line. How bumpy is this year going to be? How difficult is it going to be to kind of weather the volatility that is likely to come?
Yeah, I think it's a great point, Guy. I think we really will have a higher volatility environment this year. We're not really expecting stocks to dramatically appreciate this year. It's tough to compound the year that we had last year. So we think that we're going to have probably, a lower or mid to double-digit increase this year at best. And then most of that likely that will be just following earnings growth, because as we said, earlier, with the Fed raising rates, multiples typically contract. And so you basically, the baton is going to be handed from multiple expansion to earnings growth.
And in terms of the role that Omicron, the virus, is going to play in your outlook, we're seeing some fairly significant cases in areas around the United States. But if you look to where I am right now in the UK, cases are coming down almost as quickly as they went up.
Yeah, and that's what we're hoping that we see here in the U.S. The similar thing as we saw in South Africa, the cases, they were parabolic almost at the beginning, and then they've dropped off substantially, as similar to as you mentioned in the UK. So that's what we think is going to happen here in the U.S. You have increased vaccination, increased boosters, increased therapeutics. So we think that along with just, I guess, I dare say herd immunity, but I think that we're getting to a point that the cases probably will roll over. And I think that's why when you see the market right now, that's why the market is kind of looking through the spike in cases, especially when we got to the 1 million cases in a day. The market still went up that day. And I think it's similar to, I don't like to have analogies to financials, but I think that, we had inflation, which seemed pretty hot. It seemed to the market's thinking that it's probably peaking soon. I think similar to Omicron cases, that the market is probably is also thinking that we are the worst is behind us.